In the landscape of modern entertainment, the NFL contract is the ultimate symbol of generational wealth. Every spring, we watch sports tickers flash astronomical numbers. A star quarterback signs a $250 million extension, or a first-round draft pick secures a guaranteed $20 million contract. The media treats these press releases like lottery wins. When the public hears that the average NFL player earns roughly $3.2 million a year, they naturally assume these athletes are walking around with liquid millions set up securely for the rest of their lives. But if you step out of the stadium and audit the actual bank accounts of active NFL players, the illusion of the mega millionaire instantly shatters. Welcome to the brutal reality of professional sports finance, a world where a player's gross contract value has almost nothing to do with the cash that hits their checking account. Because behind the headline, numbers lies a relentless gauntlet of mandatory deductions. What if I told you that over half of an NFL contract disappears before the player ever sees it? What if their wealth is heavily eroded by a highly aggressive, invisible multi-state tax system? And what if the average NFL player is running a career that lasts only 3.3 years, meaning their net earnings have to survive a lifetime? Today, we are running a strict financial audit on the NFL locker room. We will strip away the PR hype of contract announcements, calculate the immediate cost of representation, expose the legal trap of the multi-state Jock Tax, and map the real net return of the ultimate physical gamble. Let's find out what a gladiator actually takes home. Let's begin the audit at the very moment the contract is signed. Before a player even takes a single snap at training camp, two non-negotiable entities take their slice of the pie right off the top: the agent and the union. To get into the league, players rely on certified sports agents to handle grueling contract negotiations. The NFL Players Association strictly caps agent commissions on player salaries at a maximum of 3%, while elite superstars might negotiate this down to 1.5%. The vast majority of players are paying the full 3%. On a $3 million annual salary, that's an immediate $90,000 sent straight to representation. And if that agent secures off-field endorsement deals or shoe contracts, the NFLPA cap no longer applies. Agents routinely take anywhere from 10 to 20% of all marketing revenue, heavily eating into a player's side income. Next come mandatory union dues. To step onto an NFL field, players must remain active members of the NFLPA, which requires flat annual dues. While it sounds minor compared to their salary, it adds to a growing stack of structural deductions that occur before a single government tax is assessed. Crucially, we must address the guaranteed money trap. Unlike Major League Baseball or the NBA, where contracts are 100% legally guaranteed, NFL contracts are mostly built on paper fluff. A $10 million contract might only have $3 million in true guarantees. If a player suffers a career-ending injury or underperforms in Week 4, the team can cut them instantly, erasing the remaining millions. The agent, however, still collects their percentage on every dollar that was paid. Now, let's talk about the single most complex, aggressive fiscal penalty in professional sports, the Jock Tax. Most citizens pay income tax strictly to the state where they live and reside. Professional athletes, however, are hit with a specialized non-resident tax rule every time they cross state lines for work. States calculate this using a metric called duty days. A duty day includes every single day an athlete is required to work, including mandatory minicamps, official practice days, film sessions, and game days. Typically, an NFL season consists of roughly 170 to 200 total duty days. If a team travels to California for a Sunday game and arrives on Thursday night, they spend 4 duty days inside the state. California's franchise tax board legally claims 4/200ths of that player's entire annual contract and taxes it at their top state bracket of 13.3%. Think about how penalizing this is over a 17-game season. An NFL player doesn't just file one tax return. By the end of January, a standard player will routinely have to file 10 to 12 different state and local tax returns for almost every away stadium they set foot in. The compliance costs alone require high-fee specialized sports CPAs just to navigate the multi-state nightmare. When you overlay the maximum 37% federal tax rate on top of these hyper-aggressive localized jock taxes, the government effortlessly positions itself as the primary benefactor of an NFL career, instantly confiscating roughly 43 to 46% of gross earnings before personal expenses are even factored in. In corporate America, your employer provides your laptop, your office, and your healthcare. In the NFL, You are the business asset, and the financial cost of protecting, maintaining, and repairing that asset falls squarely on your own shoulders. To survive the extreme physical toll of professional football, players spend massive amounts of out-of-pocket, post-tax cash on physical upkeep. Teams provide basic training staff, but staying elite requires private off-season speed coaches, dedicated personal physical therapists, hyperbaric chamber rentals, and custom meal prep chefs. This overhead routinely costs players between $50,000 and $100,000 a year. Then comes the cost of wealth preservation. Because an athlete's earnings are front-loaded into a tiny window, hiring a reputable fiduciary wealth management team is non-negotiable. Financial advisors typically charge a traditional 1% management fee annually on their earnings, further shaving down their available cash flow. This brings us to the most dangerous aspect of the athlete financial trap, the longevity illusion. A regular professional has 40 years to grow their earnings, climb brackets, and let compound interest build. An average NFL player's career is completely over by age 26 or 27. That means whatever net liquid wealth they accumulate during those 3 short years must be stretched to fund the remaining 50 to 60 years of their life. If they spend like a multimillionaire during their playing days, they face total financial ruin within years of retirement. To see the raw, unvarnished truth of an NFL paycheck, let's run a definitive, real-world seasonal balance sheet. Let's look at what an established, mid-tier veteran player actually keeps on a $2 million single-season contract. Now, to be clear, the rookie minimum is $885,000, and superstars earn $50 million plus, but most players live somewhere in the middle. For this audit, we're using a mid-tier veteran earning $2 million, a realistic, representative contract for a player who's proven enough to stick on a roster, but isn't a household name. This is the meat of the NFL's middle class. We start with a gross contract value of $2 million. First, we subtract the maximum 3% agent commission, taking away $60,000. Next, we apply flat NFLPA union dues, removing $15,000. Our adjusted gross income sits at $1,925,000. Now the government takes its share. We subtract the top 37% federal income tax bracket, which slashes $740,000. Next, we apply high earner FICA and Medicare taxes, pulling out $47,000. Then, we factor in a blended average for state income and non-resident Jock taxes, removing roughly $150,000. Finally, we deduct professional operational expenses. A standard 1% wealth management fee takes away $20,000. Out-of-pocket elite trainers, chefs, and physical therapy remove another $50,000. The final result? Out of a headline, grabbing $2 million contract, the player actually takes home $913,000 in real, spendable liquid cash. Over 54% of their contract has completely evaporated into fees, taxes, and mandatory corporate upkeep. This is the financial trap of the modern gladiator. They take on near total physical risk, subject their bodies to permanent structural damage, and enter a career with an incredibly brief shelf life, all while operating as an involuntary pass-through entity for tax agencies and representation fees. The millions are real on paper, but the cash in hand is a completely different game. If you were drafted into the league, would you opt for a tax-free state team, or just focus on maximizing the upfront paper guarantees? Let me know in the comments below. Thanks for watching, and next time, we're auditing what a real estate agent actually keeps after commission splits and marketing costs. Subscribe so you don't miss it.